They'll be met with the exact same tariff unless they drop it. And that's what reciprocal means. And we may do it as early as today, or we'll wait till Monday or Tuesday. But that's what we're going to do. We're going to charge the same thing. It's not fair. Never has been fair.
$62 billion. That's the amount of money that fled the United States and moved to Canada in just 12 months. Not slowed down, fled. This isn't a market correction. This is a fundamental repricing of American risk. And it's happening right now. Everything in this video is based on public information, historical context, and my own analysis. In 2024, everything looked normal by historical standards.
For Donald Trump, speaking to the World Economic Forum by video link, his get it done list for global business and government leaders was lengthy, forceful,
Say you can always become a state.
and more than a few times aimed at Canada.
Canada has been very tough to deal with over the years. And
His reiteration of tariff threats against Canada said to have brought gasps in the crowd, seeming to suggest if Canada doesn't do his bidding, the U.S. could simply stop buying.
We don't need them to make our cars, and they make a lot of them. We don't need their lumber because we have our own forests, et cetera, et cetera. We don't need their oil and gas. We have more than anybody.
Of over $100 billion in the wrong direction in just 1 year. To put that in perspective, we're talking about the kind of capital movement you'd normally see during a major financial crisis or a war. Except there's no banking collapse here, no military conflict. What we're witnessing is something different, a crisis of predictability. And when institutional investors lose confidence in predictability, they move their money fast. The catalyst wasn't subtle. In early 2025, the United States government invoked the International Emergency Economic Powers Act against Canada. This law, passed by Congress in 1977, was designed as a tool for responding to genuine national security emergencies. It's the legal mechanism that presidents have used to freeze assets of terrorist organizations and sanction rogue states. President Carter used it during the Iran hostage crisis in 1979 to freeze Iranian assets. President George H.W. Bush used it against Iraq before the Gulf War. After September 11th, it became a key tool in combating terrorist financing. For decades, this law was reserved for adversaries, threats, and hostile actors. In 2025, it was used to regulate commerce with Canada over disputes involving dairy quotas and softwood lumber. The same legal authority used to combat international terrorism was deployed against America's closest ally and largest trading partner over cheese and timber. Market analysts called this development absurd on its face, but the effect—
tremendous tariff on lumber and things as such, and yet we don't need their lumber. We have more lumber than they do. We don't need Canada's lumber. So what I'm doing is I'll be signing an executive order freeing up our forests so that we're allowed to take down trees and make a lot of money and then reharvest trees. Also, we're cutting fire divides. A fire divide is a 50-yard to 70-yard swath where the trees can't, it's long enough so trees don't burn forever until you can get them out. And those trees can be sold and made a lot of money with. But we'll be doing that. We don't need trees from Canada. We don't need cars from Canada. We don't need energy from Canada. We don't need anything from Canada.
Toward those offering greater rule consistency. What made this particularly striking was the market's reaction during the crisis. Normally, during periods of global tension, investors rush to the safety of the US dollar. It's been the global safe haven for generations. Flight to quality, they call it. But this time, the exact opposite happened. The dollar weakened while gold surged past $5,000 an ounce. This wasn't just about inflation. Gold is the ultimate insurance policy against institutional chaos. When gold prices spike like this, it's a barometer of institutional distrust. It's a massive global vote of no confidence in the stability of the financial system itself. Think about what that means. Global investors weren't running toward the United States during a crisis. They were running away from it. Now, let's talk about the type of money that's leaving, because this distinction matters enormously. When we say $62 billion fled the United States, we're not talking about hot money, the kind that jumps around on computer screens chasing quarter-point yield differences. We're talking about foreign direct investment, what economists call patient capital. This is the money used to build factories, create long-term jobs, acquire companies, and enhance productivity. This is capital that commits for decades, not days. In the first 3 quarters of 2025, Canadian direct investment into the United States fell off a cliff, dropping from nearly $46 billion down to just $14 billion. On an annual basis, this is on track to be the lowest level since 2009, during the depths of the global financial crisis. But here's what makes it even more alarming. This wasn't just a pause in new projects. The data shows a shift to net divestment. Canadian companies aren't just refusing to buy new U.S. assets, they're actively selling off the ones they already own. The main driver has been a sharp pullback in mergers and acquisitions, which shifted from $15.3 billion in net investment in 2024 to roughly $18 billion in net divestment in 2025. That's a $33 billion swing in corporate confidence in a single year. The modest inflows that remain are largely just reinvested earnings rather than fresh capital crossing the border. Companies that already have operations in the United States are maintaining them, but new commitments have essentially stopped. Why is this happening? Because capital isn't like water. It doesn't just flow instantly to the lowest point. Capital is sticky. It requires infrastructure, skilled labor, legal certainty, and most importantly, trust. When you demonstrate a willingness to reinterpret trade agreements, like the USMCA, which replaced NAFTA and was negotiated and signed just a few years ago, you destroy the trust required for a multinational corporation to build a billion-dollar facility in Ohio or Michigan. That agreement, the USMCA, was supposed to be the legal foundation for North American trade for decades. It was negotiated specifically to provide businesses with long-term certainty. When that certainty evaporates, so does investment. Instead, these firms are looking at their global footprints and deciding that perhaps Europe or Asia offer regulatory environments they can rely on for the duration of a major capital project. This is how you lose not just money, but the productive capacity that money would have built. And it's not just happening on one side. U.S. direct investment into Canada has also slowed significantly, reflecting rising uncertainty on both sides of the border about the benefits of continued deep economic integration. The entire model of North American supply chain integration is being called into question. While headlines focus on billions in capital flows, there's a hidden cost structure that's hitting ordinary households in ways that don't show up in tariff headlines. Basic trade theory is clear on this point. Tariffs aren't taxes on foreigners. They're taxes on your own consumers and a constraint on domestic efficiency. Every tariff on Canadian aluminum is a tax on American beer cans, automobiles, and construction projects. Every barrier to Canadian energy is a cost increase for American utility bills and manufacturing inputs. According to economic analysis, these tariffs added up to an average cost increase of approximately $1,000 for every single American household in 2025. These costs get passed down through the production chain until they land in the wallets of American families, manifesting as persistent inflation that the Federal Reserve then struggles to manage without triggering a recession. There are also massive costs in sectors that don't make headlines. Canadian tourism to the United States collapsed by a third in 2025. Think about the economic impact. Hotels, restaurants, retail shops, and entire communities along the border that have relied on that cross-border travel for generations. Billions of dollars in revenue simply vanished. Then there's the automotive sector, which functions as the circulatory system of the North American economy. We don't really manufacture American cars or Canadian cars. We manufacture North American cars. A single vehicle component might cross the border 6 or 7 times during the production process. Steel gets mined in Canada, stamped in Detroit, assembled in Ontario, receives final components in Ohio. This isn't inefficiency. This is sophisticated supply chain optimization that has evolved over decades to put each production step where it's most cost-effective. When you impose tariffs on this system, you're essentially constricting your own arteries to see if it makes your heart beat faster. The result isn't strength, it's damage. Manufacturers aren't just raising prices, they're cutting shifts because you cannot operate a just-in-time manufacturing system when the government introduces unpredictability into the process every few weeks. Assembly lines that were designed for seamless cross-border flow are now dealing with delays, cost uncertainty, and planning paralysis. The same principle applies to the energy sector, which represents the unseen backbone of the relationship. The United States imports massive quantities of Canadian oil, natural gas, and hydroelectric power. This integration is a strategic asset. It insulates American consumers and manufacturers from supply shocks in the Middle East and provides energy cost stability that benefits the entire economy. By threatening this flow with tariffs and policy unpredictability, the effect is to import volatility while trading away a stable, reliable partnership for increased geopolitical risk exposure. Now, here's where the story gets interesting, because while the United States has been focused on erecting trade barriers, Canada has executed a significant strategic pivot. They've launched a comprehensive strategy. Strategies centered on domestic economic development and global relationship diversification. Canada's economic plan includes a new infrastructure fund worth over $15 billion, with a stated goal of attracting $500 billion in new private investment, combined with Buy Canada procurement policies. All of this is designed explicitly to build an economy less dependent on an unpredictable southern neighbor. In a world increasingly defined by policy volatility, Canada's adherence to predictable governance has become a surprisingly valuable asset. Money doesn't actually prefer excitement, it prefers predictability. It needs to know that a contract signed today will be enforceable tomorrow under the same legal framework. While Washington oscillates between threats and temporary pauses, Canada has maintained what investors call regulatory consistency, a commitment to established trade rules and legal frameworks. This positioning is making Canada attractive as what market analysts are calling the stability trade for 2026. Investors looking to navigate uncertain cycles are increasingly examining Canada's foundations in essential sectors: energy, healthcare, rail, infrastructure, and transportation. These aren't speculative growth sectors. They're tied to fundamental demand and long-term demographic trends that exist regardless of political cycles. Canada's energy sector continues to generate substantial cash flow. Healthcare benefits from stable regulatory frameworks. Rail transportation remains the backbone of continental trade, especially as companies look to reshore or nearshore production. And Canada is quietly emerging as a significant player in quantum computing and other long-duration innovation sectors. Importantly, these sectors haven't been bid up to the valuation extreme seen in U.S. megacap technology stocks, which leaves room for capital appreciation as money rotates toward perceived safety. There's also a psychological dynamic at work that market observers call the confidence loop. Canadian equity markets are often undervalued because domestic investor sentiment tends toward caution. But as U.S. institutional investors begin rotating into Canadian sectors specifically for stability, that external capital inflow and the optimism it represents actually reinforces the very stability those investors are seeking. It creates increased liquidity, broader analyst coverage, and renewed global attention to Canadian assets. Canada isn't reinventing capitalism. They're simply maintaining policy consistency and honoring established agreements while others don't. In an increasingly chaotic global environment, that consistency commands a premium. But here's the paradox that makes this situation fascinating. We need to talk about where Canadians themselves are putting their money, because the picture is more complex than simple nationalist narratives would suggest. Even as Canadian investors express concern about U.S. economic policy direction, they steered another $23 billion southward in June 2025 alone. Since early 2025, Canadians have accumulated a stunning $124 billion of American securities. Wait, didn't we just say capital was fleeing the United States? This is the critical nuance of the current moment. While foreign direct investment, that patience capital we discussed earlier, is in freefall, portfolio investment has continued at record levels. Canadian portfolio investment into U.S. securities reached $200 billion in the first 3 quarters of 2025. That's an all-time high. Here's the key distinction. Foreign direct investment represents long-term trust and commitment. Portfolio investment represents yield hunting and short-term return seeking. These are two fundamentally different types of capital flows, and they're telling two different stories about investor confidence. Most of the Canadian money flowing into U.S. securities, over 2/3, went into debt instruments rather than equities. Why? Because U.S. Treasury yields remained higher than Canadian government bond yields, especially as the Bank of Canada moved further into its monetary easing cycle while the Federal Reserve held rates higher for longer. On the equity side, demand was driven primarily by continued interest in large-cap U.S. technology companies, where the concentration of global innovation spending continues to attract capital despite broader concerns. The irony is this: domestic Canadian equities actually delivered higher returns for Canadian investors during this period. Canadian stocks returned roughly 25% versus 13% for U.S. holdings, once you account for the depreciation of the U.S. dollar against the Canadian dollar. So Canadian investors would have been better off staying home. But behavioral momentum and the gravitational pull of U.S. financial markets kept the money flowing south. Meanwhile, domestic investors in Canada are being forced into a different role. They're having to absorb enormous amounts of Canadian government debt that foreign investors are no longer buying. Historically, foreign buyers absorbed nearly 75% of net Government of Canada debt issuance. But with non-resident investors backing away, domestic Canadian investors had to absorb $100 billion of supply in just the first half of 2025. That's an annualized requirement of about 6% of Canada's entire GDP. If this foreign investor reluctance continues, Canada could face its own capital flow challenges, which makes trade agreement certainty and fiscal discipline critically important for Canada going forward. The grass isn't necessarily greener, it's just differently colored. This brings us to the global stage, and a question that goes far beyond North America. What happens to the US dollar's role as the world's reserve currency? The privilege of printing the global reserve currency isn't a permanent right. It's a vote of confidence that has to be continuously earned. The world holds dollars because the United States has traditionally offered the deepest, most liquid, and most legally robust financial markets on Earth. But trust, once established, can erode. The rush into gold at prices above $5,000 per ounce is more than just an inflation hedge. It's a warning signal. If global central banks and sovereign wealth funds begin to perceive the United States as a political risk jurisdiction, a place where property rights and market access can shift based on political considerations rather than legal frameworks, they will diversify their holdings. They won't dump the dollar overnight. That would be economically catastrophic for everyone. But they will stop accumulating it at the same rate. They'll hold euros, yen, yuan, and gold in larger proportions. And here's why that matters. As global demand for U.S. Treasury debt softens, even marginally, yields have to increase to attract buyers. When yields rise, the cost of financing America's substantial fiscal deficits increases dramatically. This could trigger not a crisis of spending, but a crisis of institutional credibility. We're observing the early stages of what happens when a global reserve currency issuer begins to be perceived through a political risk framework rather than a financial stability framework. As Krugman, the Nobel laureate economist and trade theory specialist, frames it, this is how hegemonies erode. It's not always dramatic. Sometimes it's simply a margin call. That's the moment when your creditors decide you've become too risky and they want their capital back. It's millions of quiet, rational decisions by investors across the world reaching the same conclusion. So where does this leave North America? The events of the past year have created fractures in what was the most integrated bilateral trade relationship in modern economic history. The fundamental question is whether this represents a temporary crisis from which the relationship can recover, or whether we're witnessing the beginning of a structural decoupling. Analysts generally describe three paths forward. The first is resolution. Tensions could cool through negotiations, policy reversals, or political change. Tariffs could be removed with the stroke of a pen. But here's the challenge. You can reverse a tariff instantly, but you cannot legislate trust back into existence. Once a corporation has spent tens or hundreds of millions of dollars relocating a supply chain out of the United States because of reliability concerns, they have virtually no incentive to move it back into a market they now perceive as subject to arbitrary policy changes. The infrastructure is gone, the relationships are severed, the institutional knowledge has dispersed. Trust, once broken at this scale, takes years or decades to rebuild. The second path is managed separation. The trade barriers might remain in place, perhaps becoming somewhat more predictable over time, but the two economies slowly drift apart as Canada continues its strategic pivot toward global diversification and domestic economic resilience. Trade continues, but the deep integration that characterized the relationship for generations gradually unwinds. Supply chains bifurcate, investment flows diminish, the economies remain connected but no longer deeply interdependent. The third path is accelerated decoupling. Policy volatility could intensify rather than stabilize. Additional barriers could be erected. Retaliatory measures could escalate. In this scenario, the integrated North American economic model that has existed since NAFTA in 1994 simply unravels. Manufacturing networks fragment entirely. Energy integration breaks down. The economic geography of the continent gets redrawn. Which path materializes depends on decisions being made right now in corporate boardrooms, government ministries, and legislative chambers. There are signs that the domestic political system is beginning to respond to the economic costs. A bipartisan resolution in the House of Representatives recently aimed to overturn the latest round of tariffs on Canada, signaling that the economic pain is becoming difficult to ignore even in a highly polarized political environment. But whether this represents a genuine policy
merely
correction,
a temporary pause remains uncertain. What we can say with confidence is this. The capital flight we're observing isn't irrational and it isn't unpatriotic. It's the rational response of investors to a measurable increase in policy unpredictability. When the fundamental rules governing a trillion-dollar trading relationship can change overnight through emergency declarations rather than through legislative process and treaty negotiation, capital reassesses risk. And when capital reassesses risk on this scale, it moves. The $62 billion that left the United States for Canada in a single year represents millions of individual decisions by investors, executives, and financial institutions, all reaching similar conclusions about where their capital is safer and where their long-term investments are more likely to be protected by stable governance frameworks until predictability returns, until policy operates within established legal frameworks rather than through emergency declarations. Until treaties are treated as binding commitments rather than suggestions subject to reinterpretation, this capital reallocation will likely continue. The market isn't making a political statement, it's making a risk calculation. And right now, that calculation is leading north. Subscribe for more calm, fact-driven analysis of how global capital markets actually work and what the data tells us about where money is moving and why. Leave your thoughts in the comments respectfully. This is a complex situation where reasonable people can look at the same information and reach different conclusions. That's not weakness. That's how markets and democracies are supposed to function.